Bullish treasuries, plummeting swap spreads, and here's another big one. An unmistakable signal that just hit its lowest level since November 2020. After plunging today, it spells big trouble for the economy just like the rest of them, except this one is unambiguous in what it's telling us. Copper to gold leaves no doubt about what the fundamental leanings of the economy are. On the one side, economic demand for one of the most critical commodities to the modern system. On the other, the historic fear hedge. Things look bad, buy gold. Put those two together and see which one is moving more decisively. You've got reflation versus breakdown and heartbreak. That's copper to gold. Better still, the ratio corroborates a whole range of other very crucial measures that we've been highlighting recently. The bull case building in the Treasury and global bond market. The alarming negatives and swaps that I went over in detail yesterday. The continued unemployment signals around even the US economy that up until very recently, everyone said was strong and resilient, maybe even too hot. That was never really the case. It's just that all these warnings were dismissed by Jay Powell's theatrics and the mainstream media's overwhelming tendency to just uncritically parrot everything he says. The thing is, each one of these indications by themselves is more than worth paying attention to. But now that they're all lining up together and pushing to stronger lows and conclusive actions, that's even more powerful. And they are all saying one thing and doing so decisively. The rate cuts are coming, and that is the bad news. The good news is that Eurodollar University has memberships and subscriptions available to help you understand these things and sort it all out. And those memberships and subscriptions are on sale at some of the best prices we've offered as part of our anniversary sale. I have a daily deep dive to dive far deeper behind all of these topics that I bring up here on YouTube, and I just did one focused on long-dated swaps and what those specifically mean. I have a daily briefing to keep you up to date on everything that's happening in money and macro, and of course the memberships with tons of videos on everything from the basics of money and financial concepts, even the basics of QE and QT that you're not going to get anywhere else. In addition to the anniversary sale, I'll be hosting a live stream here on YouTube next Tuesday night, July 23rd, 6 to 8 p.m. Eastern. Eurodollar members and subscribers will be able to ask me and a whole bunch of special guests some questions live. So check out our website for all the details about the anniversary sale as well as the live stream. It's conveniently and easy to remember, eurodollar.university. So let's get into the copper side of copper to gold. Copper had been screaming higher, getting everyone excited about potential reflation, if not inflation. But it was never anything more than a supply squeeze. It had hit a low, copper prices hit a low in middle of February, but then they really started to pick up in early March. And by April, Dr. Copper was absolutely surging, which was adding to the sticky inflation and the reflation narratives because the CPIs were up at the same time. And Dr. Copper being an important critical commodity, if copper is up, that seems like it is a direct reflection on economic fundamentals. In this case, that's true, but not the demand side of fundamentals. It was the supply side, trouble with mines, trouble sourcing new ore out of the ground, all of that stuff, especially in Peru and South America. But it drove copper prices to a record all-time high on May 21st of $5.12. That's the CME per pound. But you knew it was a supply squeeze. It was never inflation. It was not reflation. Because a supply squeeze sends the price parabolic, not the slow buildup of a recovering economy leading to reflationary levels of demand. A resurgence in demand would not see copper prices just absolutely skyrocket at a greater than 45-degree angle. That was the first red flag. But after the Chinese announced their historic rescue, it was all downhill from there because it wasn't much of a rescue, nor was it all that historic. As of today, copper prices are plunging because the third plenum is over in China. And contrary to some lagging expectations, some lingering expectations, the Chinese are not going to announce some massive, huge bazooka-style rescue. That's just not what Xi Jinping is doing. And with China not coming to the rescue of the housing market, plus weakening fundamentals, weakening demand all around the rest of the world, as of today, copper prices are down big, under $4.30 per pound at the CME, down more than a dime just today, to a 3-month low. The supply squeeze, a distant memory. And you could tell it was a supply squeeze the entire time. As Bloomberg reported in early June, as it was just starting to go in the wrong direction, China's copper inventories are growing at exactly the time of year when they should be shrinking fast, an anomaly that underscores concerns about demand in the world's biggest market. Stockpiles of the metal held in Shanghai Futures Exchange warehouses ended last week at well above 300,000 tons. That's not the biggest volume ever, but it is the most for any end of May date on record. In China's highly seasonal economy, inventories typically peak in March and slide lower as factories ramp up activity heading into the summer. So copper was screaming higher, supply was tight. China was buying a lot because supply was tight and building up a stockpile just so that they would have it ready in case they weren't able to source copper as needed. Instead, demand continues to be weak, which is why copper prices after the initial rush of buying have been moving decisively lower. And at a multi-3-month low, that doesn't suggest anything good about the direction of the global economy. We're heading back to the lows earlier in this year when a lot of commodities, not just copper, were signaling big trouble ahead. On the exact opposite side, gold has been soaring again. Gold just hit a new all-time high itself just this week, and it's up again today. I don't think it's exactly at an all-time high. I think it's close to one. But gold has been doing exceptionally well over the last more than year. So it was soaring to a new high this week. It had already jumped to a record high in April, and then went a little bit lower, bounced to another record high in May, but then seemed to settle down into June through the end of June, though it never really fell as much as some of the other commodities, including silver and copper. So gold was relatively high and hanging in there throughout June, but since June 26, it has been absolutely surging again to the point that it almost hit $2,500 per ounce for the first time this week. And gold prices are up because, well, most people say it's rate cuts, and that is true to an extent. Well, here's what Bloomberg says as the mainstream explanation for why gold prices are soaring to a record high. Bullion climbed to an all-time high of $24.8373 an ounce on Wednesday, that was yesterday, before racing gains. Gold had rallied 1.9% Tuesday to surpass a record high set in May as traders piled into bets for earlier, deeper rate cuts from the Fed, amid increasing signs that inflation is cooling toward the central bank's target. Lower borrowing costs tend to benefit the precious metal as it yields no interest. And those rate cuts fit with what conventional wisdom says about gold and everything else. The Fed is cutting rates because inflation is calming down, and as inflation is calming down, the Fed cuts rates. Not only is that a benefit to gold because there's less of an opportunity cost to hold gold, it doesn't pay any interest, it also means it's inflationary. So conventional wisdom holds that gold prices go up as an inflation hedge, and inflation goes up when the Fed cuts rates. So if the Fed's cutting rates, that's inflationary, gold prices are up. It all seems to work together. Except neither of those are true. First of all, the Fed's rate cuts are never inflationary. And second, and maybe more important in this case, at least what we're focusing on here, gold is a terrible inflation hedge. Gold is a hedge against the worst cases. In the 1970s, during the Great Inflation, the worst case just happened to be out of control inflation. But outside of the 1970s, gold has performed poorly against even the CPI for decades, for years and years on end. So gold isn't a hedge against inflation, it's a fear hedge against some of the worst cases that can erupt in a financial, monetary, or economic system. So gold is up now on rate cuts, but not because of inflation, but because of what rate cuts actually represent. The rate cuts represent the Federal Reserve finally realizing that all these warnings we see all over the financial system were correct. The Fed reacting to weakness in the marketplace, and maybe substantial weakness, that would validate what the forward-looking markets like treasuries and swaps and gold and copper to gold have been telling us all along. So gold soaring to a record high, it does relate to rate cuts, just not in the way most people understand it. So now let's put these two parts together. We've got copper on the one side and we've got gold on the other side. And this is where copper to gold makes it easy to understand and cut through the mainstream crap. When the copper to gold ratio is rising, that means that copper prices are going up as economic demand is good, not just for China but around the rest of the world, because copper is used in a whole bunch of modern stuff that goes along with the modern economy. So if copper prices are rising because the economy is generally good, that usually means that gold prices, well, they could be rising, but they're not rising nearly as much because there isn't such fear in the economy that drives demand for gold as a hedge. So as copper goes up, strong fundamentals in the economy side, gold doesn't go up nearly as much. Maybe it actually goes lower. The copper to gold ratio is rising, which is a strong fundamental reflation or even economic boom type of signal. Copper, demand in the economy, gold, fear, hedge and fear, more copper than gold, good things ahead. On the exact other side though, when copper prices either stagnate or fall because economic demand is not robust, that is of course a pretty obvious and pretty easy to understand negative signal about the global economy in general. Not just, again, specifically China, but the overall global economy. Usually during those times, gold prices are rising because of generally rising fear, rising uncertainty at the very least. So when you have copper prices that are stagnating to maybe moving lower, at the same time gold prices are rising relatively quickly and robustly, the copper to gold ratio goes down, signaling deepening trouble across the global economy and financial system from a very simple, unambiguous, fundamental set of perspectives. So again, copper to gold goes up, reflation. Copper to gold goes down, not reflation. Call it deflation because that's potentially what we're talking about here, but at least a whole range of circumstances and scenarios that are not good circumstances and scenarios. And that's, again, what rate cuts feed into. So with gold setting an all-time high and copper now falling to a 3-month low, the copper to gold ratio has come back down. The supply squeeze in copper had pushed the ratio higher, but again, that was just a temporary, transitory increase due to supply factors. Now that the supply factors are done, the copper to gold ratio just today sunk under 0.01% for the first time since November 19th of 2020. You remember November of 2020? Yeah, there was not a whole lot good back in November of 2020. At the time, the copper to gold ratio was on its way up, but that's because it was coming off the pandemic lockdown lows, which were now heading back down toward those levels. Now, the ratio, like swap spreads, very, very close correlation there. The copper to gold ratio has been moving lower ever since April of 2022. Like the swap market or the yield curve shapes, the copper to gold ratio has been signaling the transition from the upside to the supply shock to its downside. Again, consistent signals, very fundamental consistent signals that corroborate one another across a wide range of economic and financial factors. So the copper to gold ratio has been moving lower, not perfectly lower, not in a straight line lower, but pretty steadily lower since April of 2022. And it continues to go lower and lower and lower as the economy confirms that we're heading toward the downside and ultimately the end of the downside of the supply shock case. The cycle continues to move. And here we have all of these indications very strongly suggesting that not only are we moving in that way, we're getting to the most serious part of the downside to the supply shock. What really makes these signals really compelling is the fact that they corroborate one another. We're looking at the economy and financial system, monetary system from different perspectives, from different angles across the entire global system, and they tend to move with each other. They reinforce each other's signals. For example, the correspondence between copper to gold and interest rate swaps, they don't seem to have anything in common. Yet they move not in lockstep fashion. The correlation is visible. It's not perfect, it's never one-to-one, but you can clearly see how copper to gold and interest rate swap spreads move together more often than not. So if you got swap spreads that are going down, like I talked about yesterday, that's not a good sign about hedging demand in the economy, hedges that pay off when interest rates go lower. Copper to gold goes down because copper prices aren't rising, the economy's not great, no fundamental demand. At the same time, gold prices are going up, fear hedge, demand for fear hedge, uncertainty, all that kind of stuff. So it makes sense why copper to gold and interest rate swaps would correspond strongly. And then, of course, just eliminates all the ridiculous excuses for negative and falling swap spreads that we just debunk them in this one ratio. Because mainstream theory about too many treasuries and all that nonsense, anything to avoid implicating the Federal Reserve and its forecast. But all of these signals together, and as copper to gold corresponds strongly with swap spreads, that means it corresponds strongly with a whole bunch of other indications. As I mentioned, the yield curve, nominal yields, the yield curve shape, meaning the spreads on the various spreads between the various parts of the treasury curve, as well as, all the other stuff like the dollar exchange value, dealer holdings of treasury coupons and everything, collateral indications. Basically, if all of the Eurodollar signals are suggesting deflationary conditions and potential, copper to gold ratios likely corresponding with them, and therefore backing up that signal, those signals, from a deeply fundamental set of perspectives. So we can add copper and gold, therefore copper to gold, to the growing list of signals suggesting there's, first of all, that rate cuts are more than likely to happen and more than likely to happen soon, and that rate cuts are not a good sign. That's the bad news. Rate cuts are a reaction to the weakness and dangers across the financial and global system that these market signals have been warning about consistently, especially strongly over the last couple months. Eventually, the Federal Reserve will see that and cut rates, but market rates are already going lower anyway, corroborating lower growth and inflation expectations in the bullish treasury market. We've got swap spreads that are about hedging demand for cases where interest rates, short-term money rates go lower and stay lower for longer, which is consistent with copper prices that are weakening and gold prices that are strong and going to a record high. All of it fits together, especially with the economic data that continues to come in. Weak retail sales in the United States, rising unemployment, jobless claims came in strong again this week, which is not a good sign either. So the economic data is moving in the same direction. As I have been pointing out since too long ago, ever since October, you could tell there was an inflection in the economy, which swaps were already making their move, copper to gold and everything else, the treasury curve, the historic bond rally. Ever since that time, what we see is that more and more, it corroborates the downside of the supply shock. It corroborates that we're heading toward the final stage of the downside of the supply shock, which, as I said, was never going to be fun, nor was it going to be soft. I highly recommend the video I just did on swaps from the demand for hedging perspective. It will be a tremendous help, and that's the one I've got linked below. As always, thank you very much for joining me. Check out Eurodollar University's anniversary sale, our live stream next Tuesday. And thank you to all you Eurodollar University members and subscribers. And until next time, take care.